Getting a high-paying corporate job in London wasn't due to any obligation or pressure from my father, but a personal determination to build something meaningful and create a lasting legacy for Gilanis. In 1974, my grandfather and my uncles opened a small supermarket in Nakuru. It was a humble start, shelves, sacks, and a simple vision to serve with integrity. They couldn't have imagined that more than 50 years later we'd still be here, 3 generations strong, carrying that vision forward. Growing up, I watched my father and his brothers build this business through its highs and lows. During my university breaks, I immersed myself in every part of the company, stacking shelves, helping in the loading bays, and learning the ropes in finance and pricing, while soaking up knowledge from everyone I worked with. Then in 2009, I officially joined the team and stepped into a business that already felt complete. At first, it was hard to find my place or see where I could add value, but those early experiences gave me the foundation I needed to serve as a leader. It's always easier to guide a team when you've been in their shoes. When I first tested the idea of going beyond retail and into FMCG distribution back in 2010, I got on a truck myself. We were taking orders on a piece of paper. After a day's work, our first truck left almost empty, and so was my hope. But one order from one man filled it entirely. That's when I learned, sometimes legacy begins with a single brave step and a single promise kept. We've grown by keeping our word and keeping our values. Today we've grown to over 200 trucks and 12 distribution hubs operating across Kenya and 1,200 staff. When I look at the people I work with, I see them as my family. Some have been with us for 30, even 40 years. Partnership means shared ambition, moving beyond what's possible to what's next together. Growth doesn't happen alone. Having Stanbic by our side has meant more than just loans and solutions. It's meant having a partner who understands us. When we made bold moves, building towers and financing fleets, Stanbic stood with us. Together, we've turned challenges into opportunities. But in it all, our greatest pride isn't in buildings or trucks. It's in the lives we touch. Through SCAN, our family's charity, we've served over 1 million meals and helped children off the streets into schools and universities. The next chapter of growth for Gilanis is Order Now, Pay Later, which is the ONPL product that we've launched. From our research is a lot of customers that don't actually have access to working capital. And so what we've managed to do is build an algorithm that allows us to offer them credit. In addition to the ONPL side, we've actually just launched a customer-facing app. Customers will be able to place orders on our application in the comfort of their shop, in the comfort of their homes. From humble beginnings to a national network, Gilani stands as proof that when possibility becomes purpose, more is always within reach.
This is Stanbic Executive Banking, built for your ambition. You want financial stability? You grow your money. You want an upgrade? You got it. You shop, you unlock discounts. You pay via card, you get rewarded. You book a holiday, you get a discount. Your cover, your peace of mind. You worry about your kids. You secure their future with Summer Plan. You're frustrated by rent. You get affordable housing at 8.99% flat rate payable in 25 years. You need cash advance urgently. Your son graduates. Ambition never stops with Stanbic Executive Banking, and neither should you.
At Stanbic Bank, we believe true partnership is measured by the heights you reach. It's our commitment to being the quiet force behind your every power move. It's ensuring your legacy is protected so you can focus on what truly matters. For us, excellence isn't a destination. It's a standard we've upheld for 2 years running, because we know that investing skillfully, planning wisely, and living joyfully leads to winning repeatedly. We are honored to be named the best private bank for 2026. Another year of driving your growth. Stanbic Private Banking, to your continued success.
I realized that the family business isn't just a job, it's a generational calling. Leaving a high-paying corporate job in London wasn't due to any obligation or pressure from my father, but a personal determination to build something meaningful and create a lasting legacy for Gilanis. In 1974, my grandfather and my uncles opened a small supermarket in Nakuru. It was a humble start, shelves, sacks, and a simple vision to serve with integrity. They couldn't have imagined that more than 50 years later we'd still be here, 3 generations strong, carrying that vision forward. Growing up, I watched my father and his brothers build this business through its highs and lows. During my university breaks, I immersed myself in every part of the company, stacking shelves, helping in the loading bays, and learning the ropes in finance and pricing, while soaking up knowledge from everyone I worked with. Then in 2009, I officially joined the team and stepped into a business that already felt complete. At first, it was hard to find my place or see where I could add value, but those early experiences gave me the foundation I needed to serve as a leader. It's always easier to guide a team when you've been in their shoes. When I first tested the idea of going beyond retail and into FMCG distribution back in 2010, I got on a truck myself. We were taking orders on a piece of paper. After a day's work, our first truck left almost empty, and so was my hope. But one order from one man filled it entirely. That's when I learned, sometimes legacy begins with a single brave step and a single promise kept. We've grown by keeping our word and keeping our values. Today we've grown to over 200 trucks and 12 distribution hubs operating across Kenya and 1,200 staff. When I look at the people I work with, I see them as my family. Some have been with us for 30, even 40 years. Partnership means shared ambition, moving beyond what's possible to what's next together. Growth doesn't happen alone. Having Stanbic by our side has meant more than just loans and solutions. It's meant having a partner who understands us. When we made bold moves, building towers and financing fleets, Stanbic stood with us. Together, we've turned challenges into opportunities. But in it all, our greatest pride isn't in buildings or trucks. It's in the lives we touch. Through SCAN, our family's charity, we've served over 1 million meals and helped children off the streets into schools and universities. The next chapter of growth for Gilanis is Order Now, Pay Later, which is the ONPL product that we've launched. From our research is a lot of customers that don't actually have access to working capital. And so what we've managed to do is build an algorithm that allows us to offer them credit. In addition to the ONPL side, we've actually just launched a customer-facing app. Customers will be able to place orders on our application in the comfort of their shop, in the comfort of their homes. From humble beginnings to a national network, Gilani stands as proof that when possibility becomes purpose, more is always within reach.
This is Stanbic Executive Banking, built for your ambition. You want financial stability? You grow your money. You want an upgrade? You got it. You shop, you unlock discounts. You pay via card, you get rewarded. You book a holiday, you get a discount. Your cover, your peace of mind. You worry about your kids. You secure their future with Summer Plan. You're frustrated by rent. You get affordable housing at 8.99% flat rate payable in 25 years. You need cash advance urgently. Your son graduates. Ambition never stops with Stanbic Executive Banking, and neither should you.
At Stanbic Bank, we believe true partnership is measured by the heights you reach. It's our commitment to being the quiet force behind your every power move. It's ensuring your legacy is protected so you can focus on what truly matters. For us, excellence isn't a destination. It's a standard we've upheld for 2 years running because we know that investing skillfully, planning wisely, and living joyfully leads to winning repeatedly. We are honored to be named the best private bank for 2026. Another year of driving your growth. Stanbic Private Banking, to your continued success.
I realized that the family business isn't just a job, it's a generational calling. Leaving a high-paying corporate job in London wasn't due to any obligation or pressure from my father, but a personal determination to build something meaningful and create a lasting legacy for Gilanis. In 1974, my grandfather and my uncles opened a small supermarket in Nakuru. It was a humble start, shelves, sacks, and a simple vision to serve with integrity. They couldn't have imagined that more than 50 years later, we'd still be here, 3 generations strong, carrying that vision forward. Growing up, I watched my father and his brothers build this business through its highs and lows. During my university breaks, I immersed myself in every part of the company, stacking shelves, helping in the loading bays, and learning the ropes in finance and pricing, while soaking up knowledge from everyone I worked with. Then in 2009, I officially joined the team and stepped into a business that already felt complete. At first, it was hard to find my place or see where I could add value, but those early experiences gave me the foundation I needed to serve as a leader. It's always easier to guide a team when you've been in their shoes. When I first tested the idea of going beyond retail and into FMCG distribution back in 2010, I got on a truck myself. We were taking orders on a piece of paper. After a day's work, our first truck left almost empty, and so was my hope. But one order from one man filled it entirely. That's when I learned, sometimes legacy begins with a single brave step and a single promise kept. We've grown by keeping our word and keeping our values. Today we've grown to over 200 trucks and 12 distribution hubs operating across Kenya and 1,200 staff. When I look at the people I work with, I see them as my family. Some have been with us for 30, even 40 years. Partnership means shared ambition, moving beyond what's possible to what's next together. Growth doesn't happen alone. Having Stanbic by our side has meant more than just loans and solutions. It's meant having a partner who understands us. When we made bold moves, building towers and financing fleets, Stanbic stood with us. Together, we've turned challenges into opportunities. But in it all, our greatest pride isn't in buildings or trucks. It's in the lives we touch. Through SCAN, our family's charity, we've served over 1 million meals and helped children off the streets into schools and universities. The next chapter of growth for Gilanis is Order Now, Pay Later, which is the ONPL product that we've launched. From our research is a lot of customers that don't actually have access to working capital. And so what we've managed to do is build an algorithm that allows us to offer them credit. In addition to the ONPL side, we've actually just launched a customer-facing app. Customers will be able to place orders on our application in the comfort of their shop, in the comfort of their homes. From humble beginnings to a national network, Gilani stands as proof that when possibility becomes purpose, more is always within reach.
This is Stanbic Executive Banking, built for your ambition. You want financial stability? You grow your money. You want an upgrade? You got it. You shop, you unlock discounts. You pay via card, you get rewarded. You book a holiday, you get a discount. Your cover, your peace of mind. You worry about your kids. You secure their future with Summer Plan. You're frustrated by rent. You get affordable housing at 8.99% flat rate payable in 25 years. You need cash advance urgently. Your son graduates. Ambition never stops with Stanbic Executive Banking, and neither should you.
At Stanbic Bank, we believe true partnership is measured by the heights you reach. It's our commitment to being the quiet force behind your every power move. It's ensuring your legacy is protected so you can focus on what truly matters. For us, excellence isn't a destination. It's a standard we've upheld for 2 years running, because we know that investing skillfully, planning wisely, and living joyfully leads to winning repeatedly. We are honored to be named the best private bank for 2026. Another year of driving your growth. Stanbic Private Banking, to your continued success.
I realized that the family business isn't just a job. It's a generational calling. Leaving a high-paying corporate job in London wasn't due to any obligation or pressure from my father, but a personal determination to build something meaningful and create a lasting legacy for Gilanis. In 1974, my grandfather and my uncles opened a small supermarket in Nakuru. It was a humble start, shelves, sacks, and a simple vision to serve with integrity. They couldn't have imagined that more than 50 years later we'd still be here, 3 generations strong, carrying that vision forward. Growing up, I watched my father and his brothers build this business through its highs and lows. During my university breaks, I immersed myself in every part of the company, stacking shelves, helping in the loading bays, and learning the ropes in finance and pricing, while soaking up knowledge from everyone I worked with. Then in 2009, I officially joined the team and stepped into a business that already felt complete. At first, it was hard to find my place or see where I could add value, but those early experiences gave me the foundation I needed to serve as a leader. It's always easier to guide a team when you've been in their shoes. When I first tested the idea of going beyond retail and into FMCG distribution back in 2010, I got on a truck myself. We were taking orders on a piece of paper. After a day's work, our first truck left almost empty, and so was my hope. But one order from one man filled it entirely. That's when I learned, sometimes legacy begins with a single brave step and a single promise kept. We've grown by keeping our word and keeping our values. Today we've grown to over 200 trucks and 12 distribution hubs operating across Kenya, and 1,200 staff. When I look at the people I work with, I see them as my family. Some have been with us for 30, even 40 years. Partnership means shared ambition, moving beyond what's possible to what's next together. Growth doesn't happen alone. Having Stanbic by our side has meant more than just loans and solutions. It's meant having a partner who understands us. When we made bold moves, building towers and financing fleets, Stanbic stood with us. Together, we've turned challenges into opportunities. But in it all, our greatest pride isn't in buildings or trucks. It's in the lives we touch. Through SCAN, our family's charity, we've served over 1 million meals and helped children off the streets into schools and universities. The next chapter of growth for Gilanis is Order Now, Pay Later, which is the ONPL product that we've launched. From our research is a lot of customers that don't actually have access to working capital. And so what we've managed to do is build an algorithm that allows us to offer them credit. In addition to the ONPL side, we've actually just launched a customer-facing app. Customers will be able to place orders on our application in the comfort of their shop, in the comfort of their homes. From humble beginnings to a national network, Gilani stands as proof that when possibility becomes purpose, more is always within reach.
This is Stanbic Executive Banking, built for your ambition. You want financial stability? You grow your money. You want an upgrade? You got it. You shop, you unlock discounts. You pay via card, you get rewarded. You book a holiday, you get a discount. Your cover, your peace of mind. You worry about your kids. You secure their future with Summer Plan. You're frustrated by rent. You get affordable housing at 8.99% flat rate payable in 25 years. You need cash advance urgently. Your son graduates. Ambition never stops with Stanbic Executive Banking, and neither should you.
At Stanbic Bank, we believe true partnership is measured by the heights you reach. It's our commitment to being the quiet force behind your every power move. It's ensuring your legacy is protected so you can focus on what truly matters. For us, excellence isn't a destination. It's a standard we've upheld for 2 years running because we know that investing skillfully, planning wisely, and living joyfully leads to winning repeatedly. We are honored to be named the best private bank for 2026. Another year of driving your growth. Stanbic Private Banking, to your continued success.
I realized that the family business isn't just a job. It's a generational calling. Leaving a high-paying corporate job in London wasn't due to any obligation or pressure from my father, but a personal determination to build something meaningful and create a lasting legacy for Gilanis. In 1974, my grandfather and my uncles opened a small supermarket in Nakuru. It was a humble start, shelves, sacks, and a simple vision to serve with integrity. They couldn't have imagined that more than 50 years later we'd still be here, 3 generations strong, carrying that vision forward. Growing up, I watched my father and his brothers build this business through its highs and lows. During my university breaks, I immersed myself in every part of the company, stacking shelves, helping in the loading bays, and learning the ropes in finance and pricing, while soaking up knowledge from everyone I worked with. Then in 2009, I officially joined the team and stepped into a business that already felt complete. At first, it was hard to find my place or see where I could add value. But those early experiences gave me the foundation I needed to serve as a leader. It's always easier to guide a team when you've been in their shoes. When I first tested the idea of going beyond retail and into FMCG distribution back in 2010, I got on a truck myself. We were taking orders on a piece of paper. After a day's work, our first truck left almost empty, and so was my hope. But one order from one man filled it entirely. That's when I learned, sometimes legacy begins with a single brave step and a single promise kept. We've grown by keeping our word and keeping our values. Today we've grown to over 200 trucks and 12 distribution hubs operating across Kenya, and 1,200 staff. When I look at the people I work with, I see them as my family. Some have been with us for 30, even 40 years. Partnership means shared ambition, moving beyond what's possible to what's next together. Growth doesn't happen alone. Having Stanbic by our side has meant more than just loans and solutions. It's meant having a partner who understands us. When we made bold moves, building towers and financing fleets, Stanbic stood with us. Together, we've turned challenges into opportunities. But in it all, our greatest pride isn't in buildings or trucks. It's in the lives we touch. Through SCAN, our family's charity, we've served over 1 million meals and helped children off the streets into schools and universities. The next chapter of growth for Gilanis is Order Now, Pay Later, which is the ONPL product that we've launched. From our research is a lot of customers that don't actually have access to working capital. And so what we've managed to do is build an algorithm that allows us to offer them credit. In addition to the ONPL side, we've actually just launched a customer-facing app. Customers will be able to place orders on our application in the comfort of their shop, in the comfort of their homes. From humble beginnings to a national network, Gilani stands as proof that when possibility becomes purpose, more is always within reach.
This is Stanbic Executive Banking, built for your ambition. You want financial stability? You grow your money. You want an upgrade? You got it. You shop, you unlock discounts. You pay via card, you get rewarded. You book a holiday, you get a discount. Your cover, your peace of mind. You worry about your kids. You secure their future with Summer Plan. You're frustrated by rent. You get affordable housing at 8.99% flat rate payable in 25 years. You need cash advance urgently. Your son graduates. Ambition never stops with Stanbic Executive Banking, and neither should you.
Mariam, what is the time? Can I just start?
At Stanbic Bank, we believe true partnership is measured by the heights you reach. It's our commitment to being the quiet force behind your every power move.
Good
It's
morning,
ensuring
ladies
your
and
legacy is
gentlemen. Good morning, ladies and gentlemen. I just want to call the meeting to order. I hope you've had some refreshments. To kick us off in this session, the tech team, take it away.
And a very warm welcome to the Stanbic Holdings PLC full year 2025 financial results briefing. My name is Lilian Onyach, head of brand and marketing at Stanbic Bank, Kenya and South Sudan, and it is my honor to host you this morning. To our esteemed investors, members of the media, and distinguished guests, whether you are joining us here in person at the JW Marriott or watching online, thank you for making time for this important occasion. This morning, we will take you through Stanbic Holdings' financial performance for the full year that ended on the 31st December 2025, a year defined by strategic adaptation, resilience, and meaningful growth. First, our board chairperson, Mr. Joseph Muganda, will set the stage with his opening remarks. He will be followed by our regional chief executive, Dr. Joshua Oigera, who will speak to the operating landscape, our strategy, and key achievements in 2025. Our Chief Financial and Value Officer, Mr. Dennis Musau, will then take us through the group's detailed financial outcomes. We will then open the floor for a Q&A session and close with remarks from our leadership. We ask that you hold your questions until the dedicated Q&A segment so that we make the most of our time together.
Ladies and gentlemen, that is my co-moderator, Lily N. This digital clone was created yesterday. Lily Ann will be moderating with me the session today. 3 days ago, I was asked, what are you wearing? That can be a challenge for a woman. The hair to the shoes. They came and took my voice, a voice note in the office, and my hand gestures. So we are close to Lillian, not quite there yet, but very, very close. Ladies and gentlemen, this is not really just an experiment, but it really shows where technology is going. Very soon, Dr. Lily N might just attend meetings on behalf of Lily O, and possibly talk, I'm not sure whether talk less or talk more, ask for more coffee, more groundnuts. Those who sit next to me at KLC, you know. You know my weakness. But seriously, ladies and gentlemen, this is really showing where technology is going. So as I said, this is not really an experiment, but AI has allowed us to really replicate your voice, your likeness, and really how you show up. But really, as we say, AI cannot replicate the human ambition. As Standard Bank or as Stanbic Kenya, we have used AI to see how we are serving our customers better, how we show up in terms of opportunities for our customers, seeing opportunities earlier, how we unlock ideas, how we evaluate the credit worthiness of our customer, how we buy media from a marketing perspective. But technology, as I said, does not really take over the human ambition. As Lily N had introduced, without much further ado, I'd like to invite a leader who is known for his strategic steering in the corporate space, the leader who is known for very personalized style of leadership. He's known for his governance and is seen in several boardrooms. Ladies and gentlemen, it gives me great pleasure to welcome our board chair, a leader who has been steering and overseeing this organization in the last couple of years. Ladies and gentlemen, I welcome Mr. Joseph Muganda.
Good morning, everybody. The last time I was called Joseph was at the same function last year. And as I said, anytime I was called Joseph, I knew my parents were upset about something. But in the spirit of which Lily is talking about, I can confirm that this is Joe Muganda and I'm not a clone. Anyway, invited guests, our esteemed shareholders, investors and partners, welcome to our 2025 full year results briefing. This is a significant moment for us to reflect on a year of transformation and progress at Stanbic Holdings PLC. We appreciate you joining us today, and we are deeply thankful for the trust you continue to place in our leadership and our brand. The last 4 years have been a journey of evolution. While 2022 and 2023 were marked by high inflation and currency volatility, 2024 and 2025 signaled a definitive turning point, starting with currency appreciation and stabilization in early 2024, followed by progressive monetary policy easing cycle. Kenya's economy demonstrated remarkable strength in 2025, expanding by an estimated 4.9%, and this growth was bolstered by a robust agricultural and service sectors and a rebound in the construction supported by a muted inflationary pressure. The central bank gradually reduced the policy interest rates from 13% in July to 9% by the end of 2025, rekindling credit demand towards the second half of 2025. And against this backdrop, we successfully navigated these market dynamics by focusing on engaging and serving our clients diligently, true to our purpose that Kenya and South Sudan are our home and we drive her growth. As a result, we recorded a profit after tax of Kenya shillings 13.7 billion, similar to the prior year performance, an outcome born out of grit and resilience in a tough market. At the same time, we buttressed our balance sheet and maintained sufficient capital buffers for even more growth and economic activity accelerates. I think I'm very proud of the results given how difficult the year started. But in view of this performance, I think this is the point at which you clap. In view of this performance, the Board of Directors recommend a final dividend of Kenya shillings 18.55 per ordinary share, bringing the total dividend for 2025 to 22 Kenya shillings 22.35. I'm waiting for the applause. This is including the interim dividend of Kenya shillings 380 already paid in September 2025. It represents a 7.3% increase from the 20.83 paid in 2024, reflecting our balanced approach to supporting future growth, meeting capital requirements, and delivering meaningful returns to our shareholders. Our trajectory over the last 2 years has been exceptional, and since the beginning of 2024, we have returned over Kenya shillings 17 billion to our shareholders through dividends, while our share price grew by over 80% to close at Kenya shillings 198 in 2025. And it recently surpassed the Kenya shillings 250 in the first week of March 2026. Our commitment to sustainable banking remains at our core, and through the Stanbic Foundation, we continue to scale initiatives through 4 strategic pillars: enterprise growth and job creation, infrastructure development and just energy transition, climate change mitigation and adaptation, and lastly, financial inclusion. This is creating real economic opportunities for underserved communities. We entered 2026 with high optimism, buoyed by our resilience in 2025, and Kenya has received a strong endorsement in January 2026 when Moody's rating upgraded the sovereign rating to B3 from CAA1, and we look with the outlook revised to stable. This upgrade, among other recent positive indicators, reinforces our confidence about the opportunities ahead. Our strategic focus remains anchored on enhancing client experience, expanding and differentiating our value proposition, and leveraging technology and innovation to drive sustainable growth across all segments. In closing, I extend my deepest gratitude to all our stakeholders, our shareholders, customers, regulators, employees, and business partners for your continued trust and support. I acknowledge the unwavering commitment of our management team and recognize our talented team whose dedication remains the cornerstone of these results. We have strengthened our core and stand ready for an even more successful year ahead. Asanteni sana. Thank you.
Good morning and a very warm welcome to the Stanbic Holdings. Thank you so much, Mr. Moganda. The board's confidence in our performance, as evidenced by the dividend announcement you have just heard, is a powerful statement of the strength of this institution. As Mr. Moganda has outlined, the operating environment demanded careful navigation. What I am confident you will find compelling is how our leadership translated that context into clear, purposeful strategy and tangible results.
Thank you, Lillian N. And to transition to the next segment, ladies and gentlemen, if you do ChatGPT or if you use the co-pilot and you ask yourself to describe the next speaker, what it says is that the person is a transformational banking leader, somebody who is known for strategic, performance-driven approach, somebody who has financial discipline, who is calm and analytical leadership style. Gives me great pleasure to welcome our regional CE, who has been the steer of our strategic initiative for the last 3 years. Thank you.
Thank you very much, Lillian, and good to see all of you in the house. When Julius and Mboko always visits these forums, I don't know where he is today. Good to see you. I think you forced me to give a story. And I want you to reflect back on what is on the screen. And many of us have many debates around the wild-based immigration. And there are many more animals, but obviously wild-based is what we normally know. And there's always a number, how many wild-based actually cross the Mara River. And so our media team and marketing team has done a great job on putting some nice imagery for Kenya, which is great for you to reflect on. But I wanted to start my presentation on reflecting on between 1 million and 1.5 million wild beasts actually do cross. Most of you may have seen it, may have visited. I was asking, I think it's, not ChatGPT, I was asking, I think it's Copilot, how many tourists have actually visited in the last 15 years into the Masai Mara and Serengeti. It was a little bit closer to 7.5 million, which is 500,000 a year. But you may wonder, why am I saying this story? The river itself is a difficult course to navigate. For those of you, especially during the high seasons, the wildebeests cover more than 3,000 kilometers in this journey. And you can track this for those who love tourism. And the risks are highly visible. Yet, actually, in these conversations, they don't cross because they have no instinct on the risks in the environment that they are. But the fundamentals generally ahead of the river are undeniable. So on the other side, you know what they're looking for. So I would say here, opportunity outweighs risks, if you anticipate what you see. And the cost of standing still is far greater than the cost of moving forward. And I say this story because that is the lens that the financial sector has actually played in our market and Stanbic Holdings in the last 3 years. Chairman spoke about the last 3 years. We managed through a very high rates. Our currency had a lot of depreciation, if you remember, in this cycle. And it's good to look at cycles in this moment in my conversations. At one time, we spoke about a currency of 156 for the shilling to the dollar. Global inflation was much higher. In 2023, it was more than 8.7% at some stage. And private sector credit in our markets had briefly contracted to minus 1.1%. And as Stanbic, we did not retreat because of those situations as an organization. We remained disciplined as an organization. We preserve the quality of our capital as an organizations, and we continue to invest in many areas of our business, in our capabilities, in our businesses, in our segments, because conditions finally turn. And the conditions turn, we have to be ready to take opportunities. And that is the story that we see for the migrations. And today, you look at the last few years, the conditions have turned. The central bank rate has been cut from 13% to 9% in the last 12 months. The shilling has recovered strongly from 2023. Our forex reserves stand at the highest level today than they were before, at 12.4 billion, more than 5 months of import cover. And private sector credit is again expanding. And I paint that position to look at the context of the region. And East Africa, our core market for us, for investors in the room, is growing much faster than any other person or any other country in the continent and in the world. Actually, 5 of the 7 fastest growing economies are all in this part. So I'm just giving you a background on the conversations as I move into my presentations. So I think it is that context I wanted to set that shows that the year 2025, we strengthened back. Our Fitch ratings was a B stable rating. If I look at our own NPS score, so just in terms of context, showed 8% increase year on year. Our loss ratios were 0.6%. Our NPLs was lower. We got many accolades in the industry. So I give you that story to say, and we got many awards actually, including the best investment bank that we have always gotten for years, thanks to the CIB team. And also for the first time, the best sovereign bond on the continent that was issued last year. So that crossing, in my view, just reflecting to the question that Julian always asks, is that crossing of Mara River is always behind us as an industry and for us as Stanbic Group. And what looks ahead is the context I want to share in a couple of slides. So first, if I speak about globally, just go back to the previous slide on the global context. A lot has changed. And I'll pick up just two elements for you. Inflation has fallen overall, same for us, it's a global context. And we are a little bit much more predictable. Growth has more or less converged. So if you look at growth levels for countries, GDP growth is now between 3.5% and 4%. And therefore, it's a great environment for lending, for investment banks, for institution of our capabilities, cross-border payments across the regions, trade finance for ourselves. So we are well positioned to be able to navigate the complexity that you will see in our markets. And that is the strength of the brand or the organization we have for Stanbic. If I go to the next slide, I'd like to speak a little bit more about what do we see from the region. And it's exciting to see, what has always been told for many years, but obviously sitting in a geographical epicenter where strong economies are, where growth is accelerating. When you speak about a 4.9% going to a 5.2% for Kenya, Uganda is at 7.6%. That just shows you the momentum. Central bank cutting its rate to signal monetary policy easing. South Sudan was an outlier last year. So we're in an environment where growth is accelerating and is solid. And I will say that for our businesses and for trade corridors, the region is entering what I would say as very synchronized monetary policy easing, growth acceleration in the markets, and creating tailwinds which are significant for banking sector expansion. So you won't be surprised to see a lot of banks coming into our markets because this is really an archetype of growth that you will see. And loans will become affordable. We are rated as the second much more affordable bank to borrow from in the market from central bank data that is published every single month. So credit conditions, if you ask our risk teams, Mushai and the rest, are improving, and you'll see that from our balance sheet expansion significantly this year. And it's across many sectors. And the good thing about it is that we can see that growth in our retail business, you see that in our business banking business, and largely on our CIB franchise. So you see that across the corridors of our business. So I would say that with inflation easing in our markets, the conditions for real activity for individuals, for families, for businesses is actually coming strong in our markets. If I look at the next slide, I've spoken about this a bit more. This is quite exciting for me because Stanbic and in our markets, I would say we are in the epicenter of the fastest growing economic corridor. And it's a structural advantage for our markets. Now, we may see it and say, but we have always, when you live in this center, you don't always acknowledge. But someone like me who travels across the continent, we can see a lot of changes. And no wonder you see a lot of investment and capital flowing into Nairobi and into Kenya, especially the capital markets. It's just the level of growth that you're seeing. And that growth, in my view, is not cyclical. There is an element of it which is a mega trend. And that mega trend is either technology, is either trade, is going to be connectivity, and obviously it's going to be demographics in the markets where we are in to be. So it's also very structural in the way we see our markets running. We anticipate the region to reach close to $1 trillion by 2030, which gives us comparable to many economies across the globe. With a population anticipated at 500 million plus and a median age of around 21, you will see a lot of work happening across the regions that we sit. The size of the economies is quite significant, and I just want to pick up two items. Across the continent, East Africa still grows the fastest. Our growth is 4.9%, so it means we are kind of pumping a little bit much higher compared to our size on the continent. If you compare the northern side, the western part of Africa, the southern part, and the Central Africa region. And that growth for me is a footprint that we can take advantage of as an organization. So I call it a high velocity corridor for growth for our businesses. Whether it's trade, which is Wanja's business, and CIB business is very significant in terms of building a great opportunity for cross-border collaboration. One of the countries that grows much faster outside Ethiopia is Rwanda, which grows at 8%. And that's an area to be able to build. So I would say that East Africa overall is a very significant attraction point for not just global capital, and Stanbic is quite well positioned to be a natural being able enabler of investment in the markets where we are today. Let me just come back and speak much closer to home. What do we see in our market? So one more slide about the Kenyan context. And I want to summarize for you on that slide one or two messages. Kenya's macroeconomic fundamentals for 2025 from 2023 today are the most favorable today environment in the last 3 years. Every single action from the central bank, and we must salute here work done by Dr. Thuge, the governor of the Central Bank of Kenya, and his team at MPC. And the cycle for credit that you see expansion later on in our results demonstrates what you see around the actions. We don't always give credit to the work done to address your macro issues, to address the monetary policy issues across the last few years. And sometimes, because we always ask questions, but that cycle, in many years, there's a rebound. And that rebound shows you that as inflation settles, rates come down, credit starts to expand, we are in that corridor of credit of double digits as we move forward. So this data shows you that it's not about an aspiration. We are seeing the landing value of the actions being made in the markets. The shillings, I've spoken about it much before. Now, when you look at the shilling stability, lower rates that we have, and obviously recovering credit growth, and we've seen that in our large clients, in our SMEs, and also in our personal banking clients, and a very robust foreign currency reserves for the country, that is an ideal environment for our businesses. Our wholesale banking business teams, our retail lending business teams, our personal consumer businesses, you see that growing significantly. So Kenya is in a very good shape. And we've also done Kesonia transition in the last year. So that we're among the early adopters. And you see that adjustment in our client pricing models this year. So I sense the year has been characterized by expansionary model for credit, which is positive. And obviously banks are shifting, banks of our nature are shifting our design of our balance sheets, not just from global markets only, but really an architecture for trade and business as the years come forward. So that's the context, and I was taking a bit longer to show you the global context, the regional context, Kenya's context. Let me speak about ourselves as Stanbic. So one more slide. So just reflections around the context, how we delivered on our strategy, and I will hand over to Dennis much later on to speak about the results. So what I would say up around this slide is I'm very impressed to see growth in our physical and client footprint. In a market that was dynamic and competitive, our client volume increased by 8% year-on-year basis. And in a competitive market, I would say that reflects our strong strategy, and which is on your left, for our deepening our relationship across all our business segments, whether it's insurance, smaller businesses, SMEs, personal banking clients, CIB clients. That momentum of growth in a market like this is a strong potential for our own brand. That also gives us broader revenue diversifications, whether it's on banking, insurance. We are well known on securities and advisory and capital markets, and our work we are doing on our foundations. So that's a strong part for our businesses across. Our networks improved, service centers to 44 from what they were before. Our CDMs and ATM increased to 135. So the activity to enhance presence and get more clients demonstrates our ambition to continue to grow in the markets where we are. The next slide talks about just our core priorities. I want to speak about this slide about that's really what leads our 3-year horizon. And our journey is to deliver an ROE of 23 to 25%, which will put us in the position of one of the best performing listed banks within the region and potentially actually within the continent. And that is an ambition for us for 2026. And that comes from stronger growth of revenues, 14-16% growth revenue ambition that we have, which is your CAGR for the last 3 years to 2026. Now, when I talk about monetary easing in the last 3 years, that gives you a good growth of credit overall in the market, and that's a good pipeline for our CIB business, our BCB business, PPB business. That's a very good momentum for ourselves. Our NPLs are sub 9%. So when industry is a significant level of 15-16%, the discipline for us and the room to build much more risk, which is good risk, is a good moment for us to continue growing our businesses. And you can see already that our CLR at 0.6% demonstrates we are already winning that early in advance. So our targets are bold, which I would say they are achievable, and they are engineered in our plans on a daily basis in our businesses. And I'll speak that into the next 3 slides before hand over to Dennis. Let's go to the next slide. Obviously, the market has a very important context to look at. Many opportunities continue to evolve, continue to arise. And those revenue pools, already the bank has got products. Already the group has got products. And we have pipelines, whether you're looking at affordable housing, which is a massive activation at national level. And Abraham's business is the second largest home affordable housing lender in the market today. And that will continue into the horizon. When you look at liability management, our bank has been well recognized for being at the forefront of supporting sovereign bonds, supporting liability management, and transitioning the international debt capital markets for our sovereigns and the markets. If you look at the work we're doing on energy and petroleum, a lot of work supporting the G2G imports last year. So there's also an element for us on financing on energy transition, but also involving our clients on trade corridors in our markets. Privatizations, a lot of advisories, and you've seen a massive listing yesterday in the capital markets and NSC. And that work is something we are very much prepared to take advantage and lead as an organizations. Recovering strongly on market share on diaspora remittances last year, nearly $600 million into the transactions for cross-border, and obviously our work on infrastructure through PPPs. So all these areas gives you a chance to say that those opportunities link into what you're doing in our own organizations. So one of our top priorities, there are three buckets, is around client experience. And there are many measures on this slide. I just want to pick up a few. The way I look at client experience is many broad measures. Either you look at it from amount of facilities dispersed to clients, amount of SMEs on board in our own organizations, how many diaspora clients you've served in the market, and what ecosystems we've financed over the years, whether it's sovereign bond financing, which we have done as an organizations in the same year with SME onboarding. That breadth, that's the kind of breadth shows you that we can operate quite simultaneously on both ends. Whether it's on public sector, sovereigns, large clients, SMEs, commercial clients, personal banking clients, and wealth clients. We are able to operate in the spectrum, and that is a competitive advantage that we have as Stanbic in our market. So that service across each of the areas, I want to pick up two areas that NPS gain, for me, demonstrates that it's just that transformation and shift. We get a lot of feedback from clients. NPS measures your net promoter score, what clients feel about the service levels. And I would say, especially for consumer and commercial banking, that notch increase just demonstrates that we are still getting momentum and winning in the way we bring customers in our own organizations. The second one is around executing with excellence, which is the next slide. And I would say, so next slide. For this slide shows about how we strongly managing our own organizations overall. And I may have mentioned about this before. So various measures, but the credit ratio levels today, our NPA ratios today versus industry is quite notable. And that's a result of disciplined underwriting, AI-powered. We do AI-powered monitoring and credit scoring, which is quite a very good fraud monitoring as well, using artificial intelligence tools and agentic AI as well. And that, for me, signals that we are transitioning our organization with some digital infrastructure. Lillian shared that today with our alibi. But I would say that you see that in real client solutions, and it's a reliable way of building a momentum for our business. I pick up a few items. So 21 AI bots across business units, built by our teams, across business units and tech teams. That strategy, in my view, delivers what I would say is a new momentum for growth across what you see as the emerging trends of our business. If we look at the areas for upgrades on our mobile banking apps, we are able to do regular upgrades, new tools, new digital items with Abraham and his team. And that shows you how dynamic we are utilizing technology in our own businesses. The ratings that came from Fitch for us to say, B rating gives investors, and institutional investors especially, confidence about the outlook for our brand. And we have been very solid on this rating over the years. And finally, the Kessonia rate transition, and I can answer a question much later on, demonstrate that we are proactively working with our regulator, central bank, to align just the model of new pricing regime, but also transparency for our clients. And then finally, I'll speak a little bit more about sustainability. And it's an area that is very close to the heart of our group, our board, our management team. And it's putting both lenses together on the two dimensions, running sustainable businesses and delivering returns for our shareholders. And I don't see that as trade-offs in my view. So dynamically, they are very interlinked. And those operations, whether we're dealing with biodiversity, so we are on a target to deliver 1 million trees by 2028, whether it's on the circular economy, where we're doing a lot of work on a 99.9% recycling, whether it's on green lending, where we have 21% of our portfolio, which is already sustainable finance, whether it's on women empowerment work, we're dealing with data, over 49.5 billion disbursed, whether it's on economic inclusion, for jobs created for small enterprises, or just social impact for our financial literacy training that we have done. All those areas, in my view, and the mangrove project we did actually last year, the chairman was present. So you may say it's not really a CSR project. You have to look at it and say it's risk management against the most pressing climate-driven agricultural areas, especially if you've been to Kilifi and in Malindi specific to see the impact. And our data program has been one of the most flagship, huge financial inclusion capabilities, significant amount of disbursements that we made. And I also mentioned that the teams with Dennis, having led early IFRS 1 and 2 early adoption and getting an award for it, just shows you the legacy of the group to be able to be ahead across the markets. So those are the three vectors that we have. And finally, we do get acknowledgement. So this is not just me giving accolades. This is independent across many providers, whether it's investment banking recognition, private banking recognition, sustainability, client experiences. Across those, Euromoney, Global Finance, it just demonstrates significantly we are getting good momentum as our own organizations, and that validates execution of our strategy for our organization and the dimension of banking. So that is my summary of the introductions. Thank you much, Lillian and members, for listening. I hand over back to you for the next part.
Here, how the economy is projected to grow around 5% with relative stability in the macroeconomic environment. And this is at the heart of our strategic ambition. The picture Dr. Ogara has painted is one of opportunity, and Stanbic is clearly positioning itself at the very center of that opportunity. Now, strategy is one thing, but this morning, we want to show you the numbers behind the narrative.
Thank you, Lillian. And the next speaker is described as a trusted financial strategist with strong financial expertise. He's quiet but effective leader. He is an institutional builder. And we recently learned that he can't swim. That was an article that appeared on Business Daily just this weekend. But what ChatGPT does not tell you is that the gentleman coming up also is a winner of Beyond Finance Award, the CFO's 2025. And so I'm so proud to serve alongside this gentleman who is going to walk us through unpacking the bold balance sheet restructuring, the prudent risk management, and the diversified revenue growth, and how that looks like. A gentleman who knows how to break down the numbers. Welcome, Musau.
I was walking fast so that Lillian doesn't say something that might be used. Unlike Lillian, who was a co-presenter, I'm tempted to say mimi ndio. I don't have. Good morning. It's really great to see all of you. Thank you, directors, for joining us. Thank you, investors, our analysts. I really look forward to presenting the numbers and having a discussion on what Chairman has spoken to and what our CEO has described as the economy and the market that we operated in, and how that then shows up in the outcomes out of the capital that you've entrusted us with. Doc gave a very good analogy of the Mara, and I now feel tempted to go back and visit the Mara because and relook at that river. There's another analogy, Chairman, I wanted to use just to start the conversation on this market. And every so often we are told there are two sides of a coin. There's the head and there's the tails. But I think, Chairman, there's a third side, the edge. The head and the tails represent balance. They represent predictability. They represent kind of what is known. They represent ups, downs, positives, negatives. They represent increase and decrease. But as we learned recently from our Gen Z friends, there's an in-between increase and decrease. They call it crease. That is the edge. The edge of balancing significantly reduced credit appetite in the market. It's recovering, yes, and that's great to see, because we as banks have a social contract with society to provide credit as we take deposits. So to see that turning, the edge is when that demand is not coming through. The edge is significant reduction in margins, whether you talk about FX, whether you talk about interest rates. The edge is operating in a very uncertain environment, including the fact that 2 weeks ago, the world looked a certain way. Today, it looks very different. That is in the environment in which we present these results. And my first slide kind of starts to explain that when you look at a 3-year horizon, particularly on the pricing side of things. That dotted line is the exchange rate between the dollar and Kenya shillings. Spiking in 2024, early 2024, falling significantly as one of the gifts we got on Valentine's or thereabouts in 2024, and then staying, holding at that level. When I have looked at industry numbers, FX income contributed between 20 to 25% of total banking income. This year, I have not seen the final numbers, but once, when I looked at Q3 last year, for example, it was less than 10%. So that is part of the environment we operated in. The same comment can be made of rates. So peaking at 16% T-bills, and then coming off significantly in 2025. And that environment still continues. But you have entrusted us with capital, and we had to do some work. So we fortified our balance sheet because we know these seasons will come and go, and we have resources to deploy, and we have growth to demonstrate. So our balance sheet grew by 19%. I will pause and allow you to clap. 19% growth is quite material, and I was reminding the chairman that yesterday that we have a 541 billion or $500 billion balance sheet. So if there is a club of trillionaires, we are proudly part of that club. And that is not the non-productive side of the balance sheet. It is anchored on a 19% growth in our customer lending. It is also supported by other aspects of balance sheet productivity in terms of assets under custody grew 34%. And you can see through the cycle, this is not just happenstance for 1 year. Through the cycle, you can see those lines are positive. And then the part that excites me most about our business is the continued diversification of our earnings. So having started the the asset management business in mid-2024, to see that business get to 5.3 billion shillings in terms of assets under management, led proudly by Anjali in our team, fantastic work. Really, really grateful to see that, that growth. And it is a well-funded balance sheet. If you look at the other side of it, 22% growth in liabilities. We saw a 17% growth in our customer deposits. Now, the chairman likes to ask these questions, particularly on the client engagement, because when your client engagement is right, the clients vote with their feet. They vote for you by putting trust in you. It helps that this bank is recognized by the rating agencies as one of the strongest brands, and therefore we see that in the deposits that we have. It's a well-capitalized bank. The Central Bank of Kenya has set a benchmark of 14.5% for capital. We are near 300 basis points above that, so we have sufficient buffers to weather storms that will come at us. And then we continue to ensure that we are diversified in terms of the sources of funding that we have. There's some other highlights of performance drivers, things that drove our performance in 2025, which are worth noticing. Julians will note positively that we grew our FX volumes by 52%. Julians, when the rates, the margins fall, it's almost the market shooting without missing. We fly without patching. So that's 52% growth in FX volumes as we serve our clients and remain more relevant with, to our clients. We saw SMEs, which is a business Wanja leads, 22% growth in the volume of transactions that we are doing with those customers. Our 90-day digitally active clients, a business that Abraham proudly leads, went up 74%. We lent more and more money for asset financing, and our active customers continue to increase. So that is a story of navigating the third side of the coin, the edge, amidst the challenges of the market that we had. This is our balance sheet in a snapshot. So I've shown you a bit of this in the previous slides, but if I can pick on certain items, financial investments, I know is a question that we like answering. These are transitory holdings as we await to deploy that liquidity to our customers. There's investments, there's a growth in the customer loans that I have spoken to, funded by significant growth in our liabilities, and then we continue to diversify our financing or our funding. So you will see that line on borrowings has ticked up. Very happy to see the increase in total equity, which is our shareholders' wealth. Looking at the same view for the income statement, NII largely flat at 24 billion in a market where close to 60% of our balance sheet was priced off T-bills, at least before the new risk-based pricing formula has come through. With T-bills having come off 800 basis points, you can see the amount of work that needed to be done to keep NII largely flat. The 1 billion shillings reduction in NII, in part, if you open it up, you've got 3 billion reduction in FX income compensated by other trading activity that we had to do, a lot of fee generation activity through our investment banking arm, the business that Greg leads in SBG Securities that supports our customers to invest. So that boiled together is what leads to the 3.1% reduction in income year on year. We did manage our operating expenses expertly, managed to come at 1.6% up year on year. There is a lot of detail in the disclosures around how that came to be. I am proud that we continue to provide employment to our youth. We continue to do things that ensure this brand can sustain itself beyond the team of leaders that is in front of you, and we can hand it forward to the next generation. And we continue to invest in technology and expand our surface area of service provision to our customers, and still managed 1.6% increase in operating expenses. Very happy with the work we did on credit impairment, managing our cost of risk, coming at near 48% reduction year on year at 1.6%. I think this is probably the best cost of risk number we have reported in the last 5 years. So some great work from our business teams, and particularly our recoveries teams that Edwin, our Chief Risk Officer, leads. And of course, we are a responsible citizen, so taxes must be paid. So we did incur our fair share of taxes. There are some statistics here for the analysts to reflect on. We've got our net interest margins, well managed. I think that picture for me, remember the conversation we've had around rates falling. So there was a lot of adjusting required on the interest expense side to keep margins largely flat or 10 basis points below where they were last year. Our cost-to-income ratio has ticked above the target that we have set, not necessarily because of the cost line, because of the revenue line, and therefore because that is something that we can control. I am looking forward to seeing that kind of correcting going forward. I've spoken to the cost of risk. Very proud to see that we maintained our earnings at the rate level that we presented last year. Our return on equity has dipped a little bit, but very comfortable that it continues to be market beating. And then the chairman and the directors have seen it fit to continue rewarding our shareholders for continuing to provide us with capital. I think it's worth mentioning that beyond the dividend, which is a cash payout that will go to the shareholders, our share price picked up 44% between January 2025 and December 2025. If I draw that line longer between January 2025 to where we are today, our share price has ticked up 72%. So the shareholders are receiving a wholesome return on account of the dividend that they're extracting from this, and also the share appreciation or the gains that they're making for investing in the bank. We have some graphs here to show how we manage risk. Very happy to see the progress that we are making in managing our NPL or non-performing loans and credit loss ratio, which I spoke to earlier. We continue to be sufficiently provided for because customers will go through different seasons, and we ensure that we take sufficient provisions to protect the income statement and to protect our capital. And then this is one that I know we will get to discuss. 81% stage 1 in 2022, 81% in 2023, 82% in 2024, 87% in 2025. A lot of good work in curing some of the names that have faced some winter during the lending cycles. This is how the house comes together in terms of the various legal entities and branches that we run. Starting with the bottom right, SBG Securities did a great job. Last year, that business made 20. Last year in Accountants World is 2024. So 2024, that business made 20 million. It's now made 69 million. I think that qualifies for more than 3 times. So well done to Greg and the team. And that's just not below the line kind of performance. That is 35% growth in revenue. So well done to that team. The bank assurance business up 8% year on year. Some great work by the team, Cyprian Leeds and Anjali. Again, growth in revenue was the anchor of that. Very, very, very proud of the team in South Sudan. 32% growth in profitability. When we had this conversation at the start of last year, around this time, oil was not pumping in South Sudan. There was a force majeure that was in place because of the war that was going on in the north. That corrected immediately after, and the effort of the team, Fred leads in South Sudan, is what we see there. And then, of course, the mothership, which is the bank operations in Kenya, coming largely flat or negative 1%, if you like. Boil all that into one pot, and you get a year-on-year growth of 2 million shillings. This is my last slide, and it says to you as an investing community, as an analyst community, that we continue to focus on a few select things which we think are important for our clients, that are important for continuing to create value. By the way, they found a way to insert value in my title a few years ago. So I am very, very happy when we choose a few things and focus on them, because they create, they protect, and they enhance value for their investing community. We will accelerate our growth and the scale of customers that we serve. We've got 315,000 customers today. About 3 years ago, that number was about 190,000. So there is work that we've done. We think we can get to 400,000, we can get to 500,000. We want to buttress that on top-notch client experience, just ensuring that our clients experience us in the way that they would like to experience us. They don't experience us as the next door dentist. Commercialize our investments. We've made quite a bit of investments on the front end and also in driving our operations. We want to invest in our brand, and we will continue developing our people. We are aware that the market will throw at us certain things. There are global factors, there are global macros to be managed. Locally, we are managing the transition into Kesonia, which I know is a topical issue. Regionally, we have capital issues to deal with in some of the territories that we operate in. Luckily, in Kenya, we have more capital than the recent pronouncements. We know climate risks, and really sad to have lost some lives in the capital just this past week. These are things that impact our customers, and we can't be deaf to them, because a customer's car was swept away, a customer's home was impacted. These are things we have to walk the journey with the customer, because this is what passes on the bank to the next generation. And then 2027 is an election year. It is not the first one in the existence of the bank, but we have exercised a muscle around what do you do with investor caution, what do you do with credit appetite uptake, deferred investment decisions in the investor community, and how do you help customers foresee what is likely to happen and buttress themselves or buttress their balance sheets to ensure they can sustain their businesses. That is the results of the bank for 2025.
Thank you, Dennis. The numbers speak volumes. From a 19% growth in total assets to a non-performing loan ratio of just 8%, approximately half the industry average. This is a story of a bank that has not only weathered a complex macroeconomic year, but has emerged stronger, leaner, and more strategically aligned than ever before. I know many of you have questions, and we are ready for them. We will now move into our Q&A session. I would like to invite Dr. Oigara and Dennis to join me up here as we open the floor. A few housekeeping notes. Please keep your questions focused and concise so we can accommodate as many as possible. Please state your name and your organization before your question. We will take questions from the room first and then from our online audience.
Right. I do have my technical team to support me in managing the question and answer session. Ladies and gentlemen, questions to our panel. Do I see any hands in the room? Any hands? I think let me get my phone so I can check if there are any questions online. Seth, you'll support me? Check any questions online. Right, we do have a hand.
Good morning, and thank you for having us. My name is Lilian Mikali from Sanlam Allianz Investments, and my question is on Kesonia. If you could just give us more light on what that means for yourselves, whether you're adopting Kesonia or CBR, and the impact on NIMs, and generally the outlook for the industry. Thank you.
All right. Dr. you had mentioned that you're ready to take on any Kesonia question. You'll respond to that? As we wait for the next question, Dr. you can go ahead and respond, or is it Musau you'll take her? Is it working?
Hello.
Yes.
Fantastic. Thank you, Lillian, for that question. So the thinking behind Kesonia, and you have to credit the central bank for the spirit behind the series of pricing models and changes that have been there for the last, you can go all the way to 10 years when we had interest rate capping. Everything that has come there, the spirit has, thereafter, the spirit has been around, how do you provide credit at reasonable pricing to customers? The latest episode, Kesonia, which is not unique to us, it's SOFA exists, Sonia exists, etc., is around how do you transmit monetary policy intentions or direction to customers. So with the support of the board, we did adopt a new risk-based pricing methodology, largely on Kesonia. The intention was to start with new lending 1 December 2025. We've done that for 3 months. We've done quite well, in my view anyway. And then by the end of February, we were supposed to transition every the existing facilities in Kesonia. Just giving you ballpark numbers. So yes, we have adopted Kesonia as a primary pricing methodology. We've got CBR as a backup for some of the facilities. Of course, you've got fixed and you've got FCY that don't qualify. But just to give you some ballpark numbers, 90% of the facilities we lent in between December and end of February were on Kesonia. And then there's a 10% that is on CBR. I know there's been debates around system architecture, ability to factor this etc. We've done that. And then we've done a lot of work to educate our customers on what this means, because this was not intended to create uncertainty, to create panic, to create opaqueness in the pricing that we transmit to our customers.
Okay.
I can only add 1 point.
Oh, you want to add? Yes, Dr.
You know, the Kenya shilling overnight index average, you have to salute the ingenuity of the central bank to build some convergence on how you deal with your monetary policy transmission. It's one of the classic, there's one thing that you will say is fundamental, is this one. You can look at it from the SONIA side, especially in the UK, or other markets. What I think you will see more is communication from the industry to say which clients want to use a CBR, and you can see that already in the industry, which clients want to use a Kesonia. So you will see a bit more, and banks have transitioned from 1st of this month across many segments. And what you will actually see is more transparency for clients to see what the price is point, and it's a precursor for growing credit back into what central bank speaks about, the double digits, whether it's 14, 15, 16%. So, I mean, I think we are in a very good point to take advantage of the tailwinds for this kind of transition. And if you've been watching the markets clearly, there's been fundamental convergence, especially for the rates, whether it's CBR, whether it's on your TB rate, and finally, because banks are lending to each other at this rate. Now, the details on the 5-day rollbacks, which the compound rate, which you've struggled with, I think those are details that most likely many clients don't need to be able to see at this stage, is to see what's the outcome. So I'm very positive, actually, that now all the loans have moved. We should be seeing the momentum the regulator is looking forward to. Thank you.
Thank you. I can see another question in the room. Yes, actually there are 2 questions, right? Start with the lady, okay?
My question is around Sudan. We saw that Sudan contributed around 233 million profit after tax, and that's a 32% growth, despite the volatile macroeconomic environment that we see there. So my question is, how is the group managing the currency and also the operational risks in that market, and what is the medium outlook for the Sudan business in light of the current market?
Okay, yes. Dr. You can take on that.
Yes. So I presume you are speaking about South Sudan.
Yes, South Sudan.
Because you have 2 countries between the 2, just to be sure.
Yes.
So naturally it has improved. You know, the inflations that we saw at 99%, you know, the oil exports came back. I am a big fan of the country because I travel often to South Sudan. And I will tell you that the environment you see, it's different from what you may read. The reality on the ground is different. So you see momentum, you see some activities going on. Actually, the last time I visited just recently was a complete refurbishment of the airport. So there's work that is going on because oil started flowing in the month of May. Having said that, it's a market with complexity, as you anticipate, a lot of headwinds because it's a younger economy that you're facing. And so what you're seeing there is supporting our clients overall. It's difficult to say what tomorrow will look like in a market, but our risk teams have spent enough time to look at where do you manage at the sovereign level, at the operating level in the market, and what the future looks like. It's a market you actually run it a day at a time, if you ask me. So our moment is today, the difficulty we're facing is around the capital increases that are coming from the regulator, and those conversations we are pushing back. We recommend capital aligned with the business that we do. So that's a conversation that we're having with the regulator in South Sudan. But so far, I would say that it runs until it doesn't run anymore.
Okay, we had another question on this side of the room. The gentleman, you can go ahead.
Morning, Justin Mwangi, SBGS. I have 3 questions. The first one is on net interest margin. The CEO talked about supporting the government on G2G. My understanding is that G2G is NIM dilutive. So as a bank or finance team, do you calculate like a separate NIM outside? Sorry? Okay. I'm asking about G2G and its impact on net interest margin. If you do like a separate net interest margins excluding G2G and one that includes G2G, I'm asking because your NIM reduced a bit, if that would have been higher if you played less in the G2G space. The second one is on asset quality. So first of all, congratulations on the number, 8%. We also did notice that your provisions reduced quarter on quarter in the last quarter. Just want to understand that journey and what led to that decision. Were there a lot of recoveries in Q4 that point to the health of your consumer book? And the last one is maybe a rejoinder or add up to what the CEO has said. Are you seeing corporates that used to prefer taking loans based against the T-bill now saying we want the CBR because it changes less frequently and we can see it as opposed to Kesonia, which changes much more frequently? Thank you.
Okay. Musa, will you take the G2G and the impact on NIMs?
So allow me to take the first one and the third one, and then I'll tee up Edwin, who looks after who is our CRO, to make a comment on asset quality because he's got quite a bit of meat there. So I wouldn't separate NIMS G2G because it's not another business. That's just part of our business. Before G2G we were banking oil majors. With G2G we are banking oil majors. So I wouldn't do the hard work of separating. In fact, I would want it infused more. I wouldn't want them mixed a lot more into the balance sheet. What we accept is that they are few and chunky. So we watch for what they do to the balance sheet when we have them on the balance sheet. But as to the name impact, it's not that material. Then are we seeing corporates preferring one or the two? Actually, if you think about it, Kesonia is a lot more confusing for our retail customers because our corporates borrow off SOFA. Some of them are multinationals. They're used to Sonia. They understand how that world goes. So Kesonia should not be very difficult for them. And if you think about it, the T-bill is now about 8.6 plus or minus. T-bill as the CBR is at 8.75 with a 25% basis corridor. So you're really talking about a lot more convergence in those two rates. So I wouldn't expect corporates, and our experience as we've been talking to them, they don't look very worried. The work we've had to do and we have to continue doing is to the retail customer who just wants to know, for my mortgage, I have 45,000 shillings or 100,000 shillings to pay. That detail, the look back, etc., we have to help our customers deal with that. Can we get a microphone to Edwin?
Yes.
So there's no magic in reducing your CLR. You just have to collect your debts, which we did a very good job of this year. And I think if you look at the trajectory of our credit loss ratio, which is simply the credit losses booked on P&L divided by the loan balances, you will see a number of things happening. The first is that we benefited from being very good and effective at collecting old debts, and that benefit was primarily experienced in business and commercial banking, which is run by Wanja. There was also very, very good work to the business that Abraham runs, PPB, and we've seen over time the credit losses come down. So very good at collections, very good at underwriting quality. So we've improved our underwriting quality. So less and less stuff is flowing to stage 2 and stage 3. And if you look at...
I mean, the question you're raising is a much more philosophical question, and you need to look at the infrastructure for the monetary policy. And I'm not an expert to speak about it, but in reality, the question actually, that gap is disappearing. If you look at the transmission model and the corridor for CBR, and look at the trend from 2024 in August, there's material convergence, CBR, Casonia, and to some extent, the TB rates. So you're going to give a lot of strength to the work done by MPC. So the concern you have that it's regular or not, I don't think that is actually a question to look into anymore. Because you have to study the logic, I call it the infrastructure of delivering the MPC decisions into market. And when you speak to Governor, all the times we're engaging him, he sees a convergence. So whether you choose CBR or Casonia, you'll find that actually the origin of it is where the market is. So unlike in the past, and you can see what has happened, the narrowing of the bands of the adjustment of CBR up to the last MPC meeting. So it is less of our concerns today, and I give credit to the governor and his team at the central bank. So it's not a question industry what it's about.
Okay. Daktari, I'll give you one question that is online before I go back. The question to you, Daktari, is in a year, this is from online, in a year when profitability remained flat, what has informed the increase in dividend?
Okay, so it's a very good question to raise. And for us, what Dennis spent time is explaining around, actually, if you open up our P&Ls and our growth in balance sheet and our capital adequacy, we have huge reserves and in terms of the ratios we have in buffers. So profitability in a year is not just one indicator on how you drive your dividend policy for shareholders. It's always been our value to return our own earnings into shareholders. And the increase of 7% year on year just represents the opportunity that we see, and because we have significant capital to be able to fund our growth that is coming through. And you've got a stronger balance sheet growth. So those are the things that I would say were significant. Well-managed businesses for me from a risk perspective. The adjustment, and Dennis mentioned it, I need to reinforce that point. You got strong growth in our revenues, NIRs, and you got a delta adjustment on our global markets for FX income. That is the difference as we saw in our flat returns last year.
Okay, I've seen Julian's hand is up, and there's another one on this end. We'll see how many we can take.
Thank you very much, Asante. My question goes to Doc. Section 44 of the Banking Act has refused to go away. As recently as last month, the central bank governor wrote to bank CEOs, and they're demanding a lot more. They're demanding that transmission should be immediate. No need for notices the moment MPC meets and recalibrates. What do you see as a final play out around Section 44 of the Banking Act and the approval from the CS for any interest rate adjustments? And secondly, Dennis, could you give us some color on the movements in the loans and the deposits?
Okay. I think Daktari is Section 44.
So, Julian, let me give you what the industry answer is to this question. In reality, the central bank's actions from MPC should be translated to market as they happen. So you've got the issue about notifying clients, 30 days notice, which is set up in a Consumer Protection Act. We believe that Central Bank Act needs to be able to be ahead, constitutionally, ahead of any other acts that limits the ability to transmit the mechanism from MPC. So you need to make the amendments. So you don't have another regulation that hamstrings the central bank from implementing its own policy, especially MPC. So what are we doing? So that is the real position. And if you look about it, Julian, the Central Bank Act hasn't caught up with the constitutional amendment of 2010. And that is the work that has to be driven by the central bank and the team to amend it. But as an industry, what are we doing is to build convergence. So what we're working with the central bank is to find how then in this area, today we need the minister's approval, which obviously we don't have a mechanism of getting it happen. So it will have to be a joint effort. I do appreciate the governor's pushback. And as licensees, we have to listen to the regulator. Julians, you know that 100%. We have to listen to regulators' view. My answer to you is that you see in the next quarter, by June, we should find a way of making the amendment And that amendment has to be driven by both industry, the National Treasury with the Minister, and the Central Bank collectively. And that is the work that we are doing today. Now, whether we can adjust rates immediately after MPC, that is really the right thing to do, but our regulations are limiting us from making it that direction. Dennis?
Julians, do you mind repeating the question of loans and deposits? I missed, I didn't hear very well.
Sorry about that, Dennis. There's quite a bump up in your loan book. Just give us some color in terms of how it is spread across the various buckets.
Okay, fantastic. So 230 to 272 is about 40 billion, plus or minus, in terms of the loan book growth. I would say about 45% of that is long-term financing, so term funding largely in our corporate banking business. But we've actually seen growth in all the businesses. There's another 30% which is facilities to the G2G, commonly referred. If you look at the cargoes that you had on the balance sheets this year, 2025 vis-a-vis what we closed with in 2024, and then the rest is retail. I mean, you've seen we've created 200 new homeowners. We've lent money to people to acquire assets, etc. But the chunkier ones is term financing to infrastructure projects, energy projects, etc. And then there is oil marketers financing.
We only have time for 2 more questions. The lady here had her hand up for some time, and the last gentleman on that side. We will have the panel around to take any more questions once we close the session.
Thank you, Lillian. Thank you. Allow me to laud the board for not only being the powerhouse that you are, but a blueprint of the organization brand and a trailblazer. I have 3 questions. How is the group provisioning for potential economic headwinds in 2026, particularly in key markets like Kenya and Uganda? Question 2. It's on building generational wealth or legacy planning in family-owned businesses. How is Stanbic structured to support these family-owned businesses, and how does it address its challenges? Thank you. My name is Sally Chepkorir, and I'm a shareholder.
Yeah, I didn't quite hear the first question, but the second question was on family-owned business. The first question, yes.
The first question is, how is the group provisioning for potential economic headwinds in 2026, particularly in key markets like Kenya and Uganda? Thank you.
Actually, as you respond to that, there was a question online that asked how we will respond to what is happening in the Middle East, and do we expect that to affect our performance? So as you respond to that.
Thank you. Thank you, Sally, and good to see you here for many of our sessions. I will summarize it quickly, that we are entering a phase of synchronized monetary easing in the region. So if you remember about my story I gave around just crossing the river, a lot of the actions, whether it's currency, growth, inflation, deficits, fiscal budgets, or supply, that has actually been working the last few years. So what we see is growth acceleration. That is what you're seeing in many markets. I can give you a view, Sally. Markets are growing. Tanzania last year grew credits by the market by between 14 and 16%. I mean, Kenya, we are saying we are 6%. But you can see what's happening in the region. Uganda was very close at 16%. So actually, Kenya is catching up in that. And those tailwinds is what is going to be the biggest reason for banking sector expansion for our businesses and all our other clients. So we are in a very good momentum for us. No wonder many of our economies are fast growing in the year 2025 and 2026. So the headwinds that are coming out is what you see as a crisis from the Middle East. But Sally, I want to give you a story from what I have seen. When you speak to our economist, and he's not in with us today, he always tracks crisis for the last 100 years. If you listen to Gibran, he spoke here in the conference we had, the economic conference a few weeks back. He says there's always going to be shocks in the market all the time. It's just that you don't always track it. Even after COVID, we are being used to a lot of this crisis. And his view is that then he's talking about the edge. That is really the nature, is the lay of the land. And your management team with the board is able to navigate those headwinds. That's, for me, is what I will tell you. So don't always be over nervous about the crisis. I mean, we've had a war, a massive war in the last few years. Still goes on, correct? We got a challenge in the Middle East around logistics and transportation. But from a risk perspective, and we look at that very closely, I can assure you that those are issues we look at, and we anticipate to take opportunity when they arise. So it's Kenya to come into a higher growth of credit to double digits, which is the view that you heard from the central bank. Dennis?
Dennis, you'll respond to family-owned business, or we'll invite I saw Wanja in the room. Is she still here?
I looked for Wanja when that question came up, and then when I couldn't see Wanja, I saw Anjali. So I will say something, and then I'll ask Anjali to say something, because she looks after a piece of that sustaining generational wealth, availing investment opportunities, etc., etc., to our businesses. So, Sally, I think more than 50% of Kenya's economy is driven by SMEs. SMEs are you and me seeing a market opportunity, creating something new because employment potential is not coming through, and building that. And the one hope that we all carry when we create those businesses is that we'll pass them on to the next generation. So it is very exciting when we say we have lent 70 billion shillings, new money, to SMEs. We have added to our portfolio of customers 7,554 new SMEs that we are lending. The work that we are doing with our foundation in supporting MSMEs to become bankable and economically viable, all that boils into the pot of helping those SMEs become commercially viable businesses, economically sustainable, etc., etc. And that is the part that Stanbic is doing. We do know that, though, that there's a lot more work we can do as Stanbic. And I think there's a lady called Wanja who leads that business. And the one thing that she's thinking about every day is who is the new SME in town, who is the new family-owned business in town, and how do we support them? Anjali, do you want to mention on supporting individuals in also creating businesses and sustaining wealth?
Thanks for the great question, Sally. So we've been working on family-owned businesses for a number of years, and it sits across our organization. So we have family-owned businesses in our corporate banking business, which SJ leads. We have family-owned businesses in business and commercial banking. And also in the business that Abraham leads, and Doreen, who's sitting right next to you, we have a wealth business. So we try and tie together both the corporate side and also families' individual wealth and what they focus on in passing down generational wealth. So the unit I run is called Insurance and Asset Management. So as a group, we have great capability, both in Kenya and also offshore through our Jersey, Isle of Man, and Mauritius offerings to also do succession planning. We have great competitive advantage where we own 2 fully owned trust companies. So we talk to a lot of families in Kenya and in the region about wills and succession planning, and also setting up offshore trusts to look after that. We also work with local partners to set up domestic trusts so that family succession can happen in an organized way. So there's a lot of work happening across the business units, both from the kind of corporate side and also from the family side to put that together. So we work very closely on that, and we've made some great strides. I'm happy to talk to you a little bit more about it afterwards. Thank you.
Thank you. We only have time for one last question, and it was on this end of the room. Just the last question. Go ahead.
Thank you. Good morning, Dr. Oigara. Good morning, Mr. Musau. I am Ritesh Barot, a shareholder. I just wanted to congratulate you, actually, it's not a question. Congratulations to you and to your entire team at Stanbic Holdings for the outstanding performance. And as shareholders, we are truly grateful to you for upholding and enhancing the shareholder value year on year. This is absolutely phenomenal. And thank you for the outstanding final dividend. And we hope this continues. Thank you.
Okay, that was not a question. That was a comment. Congratulations. You wanted to give a comment?
Thank you very much for the comment, and the chair and the board is here to get the perspectives. I'll just make one reflection from what we spoke today. If you look at Stanbic over the years, and for the results we presented today, and the communication around the posture, it's a bank with institutional grade risk management. We have a demonstration of our digital transformations that Abraham and the team here lead, and are very well positioned cross-scale footprint across many segments of our economy with a track record with our teams. And so whether they are, and I can assure shareholders, that whether they are headwinds, there are opportunities we face because of the franchise, regionally or diversified-wise, that gives you an anchor to lead for the growth of our business into medium term. So thank you for the comments, and back to you, Lillian.
Thank you. Thank you, ladies and gentlemen. We'll now just get closing remarks from my panel. I'll start with Musau.
I started by saying that we have a third side of a coin, which I did not define. I defined stability, predictability. The edge represents grit. The edge represents navigating what comes at us. The edge represents staying the course and supporting our customers, and our commitment to you as the investing community and the leadership that we have here is to continue supporting customers. There's going to be new headwinds. There's going to be market conditions, but our commitment as a bank in creating, in enhancing, in protecting value is to continue navigating that edge to deliver value. Thank you.
Dr. Closing remarks.
Yes, I want to finish with the story I started on the picture that is behind me.
The Mara?
Yes, I'm not a big ambassador. Please visit if you have not visited. But I will say two things that in reality, and we spend time as an industry speaking to the central bank and saying, how many mini shocks do you actually see in an economy that generally many people don't count? Whether it's your Trumpism, it's going to be your tariffs, it's going to be your wars, it's going to be your flooding, it's going to be issues coming up from climate change. In reality, this is actually the environment that in businesses run. It's important to acknowledge that that is the nature. So even as you invest, getting teams that are solid enough on risk management to navigate this. So on one side, you can see a headwind, but in reality, standing ahead of this gives you an opportunity for the tailwind. And that is the strongest value so for our growth of our balance sheet 2024, and we have momentum to build that into 2026. And thank you for joining us this morning, and have a good day.
Thank you. Thank you so much. I'll release you. I'll release Dr. and I'll release Dennis on behalf of the entire Stanbic Holdings family, our board, our leadership team that joined us today, and thousands of colleagues across Kenya and South Sudan who've made this performance possible. Thank you for joining us this moment. For members of the media, we do have our executives and the scheduled interviews that will be taking place here. I would like to thank my co-host, Lily N. I think the next session, she might just have to roll through this without my intervention. Thank you to the team who've put this together, my team, the brand and marketing team, the investor relations team that are within the finance department. Thank you very much to my colleagues who helped put this together. And with that, we close the session. Have a good morning.